Kevin, 2016 was a year which was really characterised by the bounce back in emerging markets, which caught a lot of people by surprise. Now, I've got two questions.
Yep.
Firstly, did it catch you by surprise? And secondly, is it over?
No, to answer your question, your first question, no, it didn't catch us by surprise. We're very constructive on emerging market equities. And the reasons for that are quite simple. Firstly, the markets are very cheap, too cheap in our mind. And secondly, expectations were far too pessimistic. And therefore the conditions were right for a rebound.
And so you think there's still more to come then on those grounds?
Yes, certainly. I mean, if you look at emerging markets, they have underperformed since 2011 and a significant underperformance within that. And that gives us the valuation opportunities. So absolutely, within that context, this is still early in the cycle.
What triggered it, do you think? As you've just said, you know, they've been cheap since 2011. What suddenly happened that suddenly people last year said, let's go in and buy emerging markets?
I mean, that's going back to, you know, expectations, you know, were far too negative. And I think what you saw was that corporate earnings started to be revised up, that suddenly challenged people's perceptions of how bad things were, which in fact they weren't.
Am I reading too much into this and saying it seems to me that people are now prepared to take on more risk because they see this upturn in earnings?
Well, price is a great thing that, you know, the more things go up, the more people are inclined to buy it. Yes, so that in itself is supportive, but ultimately it comes back to what I said around valuations, that emerging markets are too cheap relative to developed markets. They're at around a 40% discount. Prior to the fall, they were trading at a 10% premium. So, you know, there's still plenty to go on that score.
What are you actually doing with your funds this year?
Overweight, obviously, emerging markets, and particularly we like Asia. Markets that we like are China. Sectors that we like are particularly around industrials, commodities and financials.
So overall, there still looks to be a lot of value to be had in Asian and emerging markets this year.
Yeah, absolutely, and on a multi-year basis, I say. You know, they have underperformed since 2011. You know, that's 5 years of underperformance. You know, so we've only had 6 months or so of better markets, and the markets are still too cheap.
Generally, emerging market earnings have disappointed, and in fact for the last 2 years they've been negative. What we're seeing this year though is that earnings are actually growing. They should grow around 7%. The extent of disappointment is much lower than it has been in the previous years, and we think this is going to continue into 2017. And we think that is very good, and that will support the rally that we've already seen so far.